Okay, I hope I do this justice. So I was very lucky. I was actually in a room with Tony Robbins and Christopher Zook. These two are amazing people, and conversation of the Holy Grail of investing was really the crux of this meeting. And Ray Dalio was involved but wasn't there. All that kind of stuff. So the Holy Grail of investing. Now, here's the deal. Absolutely fascinating. There's books on it. Matter of fact, Tony Robbins just put out a book on it. It's a great read. It's very interesting. But boy, does it make me feel small. It makes 99.9% of the people in this universe feel small. It's amazing. So let's figure out what we can learn from the Holy Grail of investing. Let's figure out what it is in the first place. The Holy Grail of investing is how rich people keep getting richer. It's just the reality of it. And there is logical reasons behind it. So Harry Markowitz won the Nobel Peace Prize long before most of us, all right? He won this, well, technically back in the 90s, but he was writing the financial books that led up to the Nobel Peace Prize in the 50s, 60s, and 70s. So he's been around for quite a long time. The reality is he's the one that was the beginning of this idea of diversifying. Diversifying can reduce your risk and in some cases even increase your return. So you look at the quadrants here, you look at the standard deviation, the volatility, the risk, whatever metrics we're going to use here, down on the bottom, and the return on the left side here. And so you break this into four different boxes, and in the lower left, what nobody wants to invest here, low risk and low return. That's your bank account, right? I mean, we want to keep as little as possible in a bank account. It's got low return, well, especially your checking account. It earns no interest. It's terrible. That's not a good investment, right? Then you go out the spectrum on the risk side, you have high risk and low return, and that's even worse. That's ridiculous. I don't know why anybody would ever want to invest in high risk investments with the hopes of low returns. The one that we see quite often that we always work with and we try to mitigate that risk and diversify that risk is that high risk, high return, the upper right-hand side. And so by diversifying, the goal is to get to the Holy Grail of investing, low risk, high returns. By diversifying those high risk, high returns with other, what you'll find out is non-correlated. This is the important part. Non-correlated investments, we then lower the risk and still maintain the high returns. This is where the Holy Grail comes in. It's so important. So we have to understand what correlation is. Okay, correlation is so important. When we do the calculation of a perfect correlation, that's a +1. The one is the top of the chart. Assets that typically move in the same direction are said to have a positive correlation. The maximum calculation is a +1%. Okay, so chart kind of shows you when red goes up, blue goes up. When blue goes down, red goes down. They are perfectly correlated. Okay, then we have a negative correlation. A perfectly negative correlation is one that goes down when the other goes up. And a little hard to see in this mishmash line here, but you'll notice the blue line's going down while the red line's going up. Red line's going down as the blue line's going up. It has a perfect negative correlation. Okay? Then the goal is no correlation at all. That would be a zero calculation. That's what we're looking for. No discernible relationship in the trend of how these investments move. Okay, they're completely independent, no rhyme, no reason. They are not correlated in any way, shape, or form. This is where we have to understand its value, the value of this. So we want high risk, high return investments. We want to diversify them, reducing the risk. And it's amazing the mathematics and the skill that goes into this. And so let's look at this in the simplest of terms here. Okay, I loved this example here. Rain gear. If you were in the business of selling rain gear, and let's say the blue line is rain gear, and when it's raining, you have really good days at the store. Everybody wants to buy umbrellas and raincoats and stuff like that. But when it's sunny out, nobody wants to buy anything. So you go through peaks and valleys and peaks and valleys of good days and bad days. So the shop owner then turns and says, I got an idea. When it's not raining, it's sunny. Let's sell swimsuits. Let's sell swim attire. Let's sell goggles and sunscreen and all that kind of stuff. So when it's sunny, people come in and start buying stuff. So now our shop is busy when it rains, and it's also busy when it's sunny. And you look at the business and you look at the profitability of the business, and now all of a sudden we've smoothed out that volatility by selling something else. We've added something that is not correlated, or in this case, completely negative correlation, because we only have two items. So that kind of fixes the problem right there, a negative correlation. So when you're building a portfolio, you want to kind of think about it like this. The statistics on this and the math on this is so important, because you can go get 5 different investments and they might not be correlated to the stocks, but what if they're all correlated together? Then you're really only getting 2 different investments. So we got to make sure that we're looking at this very closely. So when we go through the math that they put together on this and the detail of what they did, the reality is they're going through and analyzing these different investment categories. And this is the hardest part, is actually finding it. And for most people, this is not real. Again, this is how the uber rich are staying rich and how the super rich are getting more rich. So one, high risk, high return. Well, you're looking at one investment of, let's say, a risk coefficient of 12. Let's just say 12% volatility that we're going to see in it. But then you get 2 investments, and all of a sudden you've reduced it to 9. Then you get 3, then you hit 4, and the mathematics on uncorrelated investments. That's a part, again, this is fictitious in the fact that we're examining the math on uncorrelated, perfectly uncorrelated investments. You're reducing the risk, the volatility by 50% by simply having 4 uncorrelated investments. And they've gone all the way out to 10, and you've got an 80% reduction. Okay? This all sounds magnificent, fantastic, wonderful. Why isn't everybody investing like this? Well, the reality is that the super rich understand how to invest in ways that they won't let the rest of us invest. When Ray Dalio really goes into this, we're talking about the sophistication of looking at, he calls them the 4 seasons of economics, periods of high inflation, periods of deflation, periods of improving economics, and periods of declining economics. These are his seasons, and his idea is really going after, let's get investments that build a portfolio together that will do well in any of these economic worlds. And how do they do that? Well, they start coming up with uncorrelated investments that we don't get access to. One of the cool ones, GP stakes. What is that? General partnership stakes. That's buying into the big wealth management firms that run the big funds, the billion-dollar funds. It's not buying into the fund. It's buying into the ownership of the firm that's charging the fees on the fund. And the fees, by the way, on average, are 2% plus 20% of the profit. The fees that these guys take in are amazing. Okay? So we're talking about an investment category of owning the companies that run these funds. That's one of the investments. Most of us can't get into. We don't get invited into these clubs. Sports team ownership, incredibly popular right now. Incredibly popular. There's a huge fund out there that owns almost a piece of almost all the sports teams, all the professional sports teams. You look at the track record and the growth and the value of these sports teams, it's phenomenal. private credit, energy, venture capital, real estate, infrastructure. They even have something they call secondaries. This is literally just money sitting on the sidelines waiting for people that need to rebalance their portfolio and sell when things are on sale. That's literally what's happening. And that happens quite often because there's lots of funds that have charters that say you have to have this mix and you have to rebalance every year. And so stuff can go on sale. Somebody might have a GP stake that needs some liquidity to go do something else and they need to get out. Well, how bad do you need to get out? How much is this going to be on sale? So they have categories of investing that they're utilizing that are the high risk, high return. Now, when I say high risk, boy, that's a little different class because I see people getting offered private investments that more often than not go to zero. Well, these things, they're not going to zero. They might do venture capital and help, 5 startups and one of them goes out of business, but they're not going all in on one startup. They're going to fund 100 startups and they're going to have some that knock it off the planet. But the key to all this is they're not correlated. We don't get access to this stuff. This was the wah, wah moment. I'm like, wait a second. I wanted to be in this. I want to do all this. And the reality is some of this stuff I can do, but there's a huge but on here. Lack of access. So first of all, getting into the GP stakes world is very difficult. You got to kind of get invited into that world. High minimums. When I say high minimums, look, I've seen the $1 million minimums, but I've also seen 10 million, 100 million. I've seen obnoxious 50 million, 100 million minimums to get into some of these investment categories. Think of sports team ownership, stuff like that, right? Then there's lack of liquidity. So this is that gotcha moment for the vast majority of us. You might have $1 million to be able to invest in this fund. That's great, but you don't get access to that money. Most of these are going to lock you up, period, with no ... The last one I looked at, it was the first 2 years you can't touch the money, and then you have access to 5% twice a year after that. That's it. So when we talk about this is for people that are investing for growth, and that's it. They have zero need for this money. Think of the Warren Buffetts of the world. The super rich can throw money in categories like this and forever and just leave the money there. It's complete insanity. So the reality is the liquidity is the problem for the vast majority of us. You can't these aren't mutual funds. These are private investment firms that are out there funding businesses. That's what they're doing. Okay. This is not a mutual fund. Difficult investment structures. Absolutely. I mean, we're talking stacks of contracts to sign just to get into funds. Complicated tax reporting. Oh yeah, you're going to have expensive tax returns, that's for sure. So the reality is this is a world that we don't live in, but we have to make sure that we understand some of this stuff and understand how we can apply this to our situation. So when we talk about how to apply this to our situation, some people can invest with the sole purpose of growth, right? There are plenty of people out there that don't need chunks of their wealth. And you can then start diversifying into the private investing world. I just caution people because the stuff that's getting sold to the people that are, 10 million less net worth type people, there's lots of people running around saying, oh, I'm doing private lending. You can invest this way and I'll get you a 10, 12, 15% return. And that's all great. But I honestly, again, everything I see, especially here in Arizona, they're feeding on people that don't know what they're investing in. And it's more likely to go to zero. Now, there's some great private investing going on out there, but the reality is a lot of it, a lot of the small stuff from investment firms nobody's ever heard of, mom and pop shops just trying to invest money, they're all going to zero. They're just scams. Be careful of this stuff. Many people cannot just invest for growth. Matter of fact, most people can't just invest for growth. Most people at some point are going to need their money, whether to fund retirement or not. So this is not for you. This holy grail of investing, the diversification, the 7, 8, 10, and really they're going after 10 assets. You look at 8 of these alternatives and add stocks and bonds to it, and you're good to go. So the reality is this is investing for growth. This is investing to be invested. This is not a plan to fund retirement. We have to understand that difference. You can read this book, get all jazzed up, and I'm going to start diversifying my portfolio, and you can get in a lot of trouble. A lot of trouble. You get into bad, high risk, high return investments, and you're going to lose a lot more often than you're going to win. You're also going to have liquidity issues, access to the money issues. So please, please understand that this investing is for the uber rich for a reason. Most people cannot do stuff like this. Diversification with uncorrelated assets reduces risk in your portfolio volatility. That is what we're going for. Ding, 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 ding. This is the lesson we have to learn. And diversification, I got news for you, is not buying 500 different stocks. Diversification is not buying international stocks and small cap and large cap and mid cap. They are very correlated, just so you know. You can do the math on these. You can find it on the internet. The correlation of different stocks is pretty darn similar. That's the reality of it. Especially nowadays. Back in the good old days when valuations of companies made sense, that we easily could put a well-diversified portfolio together. So now, bonds are not enough to diversify a stock portfolio. I made another video. Go look for it. It is a great video. Stocks and bonds are correlated more than they have been in a long time. When stocks go up, bonds go up. When bonds go down, stocks go down. Look what happened in 2022, and there's an actual reason for it, and I've got a video on that. You can't rely on just stocks and bonds. That's ridiculous, especially if you're heading off into retirement. Don't do that. That's a huge mistake. That's the anti-Holy Grail of investing, okay? More correlated assets is not diversification. If stocks and bonds are correlated, you are not diversified. More stocks to diversify other stocks is not a diversification. It's not a proper diversification. Okay, so you look at things that Ray Dalio talks about. He talks about precious metals a lot, real estate. There's lots of things. He actually kind of likes crypto. So the reality is there is some speculative investing in this. But understand that these are things that us normal people can invest in. Even people that are in retirement trying to fund their own retirement. These have liquidity. These have logical, easy ways to invest. Precious metals, there's so many different ways to invest in precious metals nowadays. Certainly, you could just buy the physical gold and store it at home. But there is also the ETF, GLD out there, paper gold, we call it. You could easily add that into the portfolio. And now there's even private investment ways for you to be able to earn interest on your gold and not have to pay for the storage. So you actually own the physical gold and you can earn interest on it. Commodities, pretty easy to add to a portfolio. Real estate. Now, I want you to think about your own personal net worth. REITs, unfortunately, have a high correlation to stocks and bonds, the publicly traded REITs. Okay, it's too washed down. There's too many layers of other people's hands in that pot. The real estate that the big investors are in actually own buildings, right? So important to understand that distinction. Sure, maybe if you're trying to put a yield portfolio together, you might want to have a little bit of REITs in there. But the reality is I'm talking about your own primary residence. I'm talking about owning a rental property. I'm talking about owning a second home. Real estate is a fantastic asset in your overall net worth. Infrastructure. There's plenty of infrastructure funds out there, lots of closed-end mutual funds that most people have access to. You can get into infrastructure. Fixed there are fixed interest investments like CDs, like MYGAs, multi-year guarantee annuities. These are fixed interest rate investments. So when stocks are going down, they're just sitting cross earning. That's an uncorrelated asset that helps a lot of retirees. Fixed indexed, can't lose, only go up. So those are you got the bank notes, the index CDs, the fixed indexed annuities. There's lots of different choices in the indexed world. So it limits your downside risk, but gives you some of the returns on the upside when the market's doing well. And then certainly cryptocurrency. So these are all things that have very low correlation that can be added. And again, we're not talking about, put 10% in each one and you've got the greatest portfolio ever. No, the super rich are making way more than we are, but they have high quality, high risk assets that they have no access to ever. That money is so locked up, it's crazy. They essentially have to go find some other billionaire to buy them out. And oh, by the way, that's why they had that category. It's on sale. So-and-so needs to get out. He needs his money. He's buying another mansion or something, whatever. The reality is we can't do that, but we can take lessons from this. And if we're in growth mode, if we're in our 30s, 40s, 50s, we can start taking stock and understand that buying that house versus renting, that is a decision. Owning a little bit of precious metals, gold, things like that, adding that in the side, just a little bit here and there, having a little commodities, having a little international, large cap, mid cap. And again, these are all on top of your typical stocks and bonds. This is not go throw all your money in these things. This is on top of your typical stock and bond portfolio. This is the diversifications that we need. We can't just sit back on stocks and bonds alone. It's not working. It's not right. You can't continue to do that. There's actual reasons that this is not working anymore. So if you want to diversify, understand the word correlation. Uncorrelated assets are diversifying. All right. I hope that conversation helps. The Holy Grail, that's the idea of the Holy Grail, and that's what us normal people can pull away from the Holy Grail. Yourinvestmentcounselor.com. If you want to meet with me for any reason, you can jump on that website and schedule an appointment. Full classes, fpfeaz.org, and certainly give us a call if you have not visited our full channel. We've got a full channel with over 250 videos. We got new videos every single week. Subscribe to this channel. It's fantastic. Like the video, give me comments, and thanks. We will see you next week.